Hello everyone and welcome to TTT Markets. I am Fotis and today I want to show you one of the most underappreciated macro indicators out there, the US railroads. Yes, the trains. Railroads sit at the heart of the real economy. They move raw materials, industrial inputs, energy, autos, housing, materials, and consumer goods. When railroad CEOs talk about demand, they are not guessing. They are describing what is physically moving across the economy. We are going to use CSX latest conference call as a real-world example and show you how to translate corporate commentary into a macro framework. So railroads give us three things macro data often doesn't. Number one, real-time demand. Number two, cross-sector visibility. And number three, less narrative bias. Unlike surveys or forecasts, rail volumes reflect what consumers are actually shipping. When rail management says demand is weak, it usually means industrial production, housing, cars, and trade flows are already slowing, not about to slow. If we look at CSX entire conference call, and if we boil it down to one macro message, it's this: there is no macro rescue coming in 2026. That alone should catch your attention because it runs counter to a lot of early year optimism in markets. So let's start with industrial production, one of the most important cyclical indicators. So here we have the CEO, Stephen Angel, the CEO of CSX, explicitly stating that in 2026 they assume flat industrial production. This is what they see, flat industrial production, low single-digit revenue growth, and no meaningful macro improvements. That tells us something critical. Companies closest to physical output are not seeing a re-industrial acceleration. This is a stall, not a rebound. GDP growth. The management also references modest GDP growth, not strong growth. This aligns with an economy that is expanding slowly, not contracting sharply, but lacking momentum. So for macro traders, this is a classic late cycle behavior, growth positive but fragile. What about inflation? What do they say about inflation? Now, this is very important. The CFO, Kevin Boone, says that inflation, right here, you can see his comments right here, inflation at the corporate level remains around 3% to 3.5%. This is not national CPI. This is what companies are actually experiencing. So this is telling us cost pressures remain sticky. Margin relief is limited. Rate cuts won't magically fix demand. From a macro perspective, this explains why customers are cautious and controlling spending. The chief commercial officer right here says that customers are carefully controlling freight spend. So they are controlling how much they are going to spend on transporting goods. Inflation and tariff pressures are weighing on decisions. Tariffs and inflation are an important factor. There is concern about a slowdown in imports after pull-forward activity in 2025. So this is telling us that global trade flows may soften, not accelerate in 2026. That's a headwind for growth-sensitive assets. What about housing? Well, railroads are deeply exposed to housing and automobiles, two of the most interest rate sensitive sectors. They confirm housing are expected to decline modestly. Affordability remains a problem. North American light vehicle production is under pressure. These are classic late cycle constraints, higher rates biting into big ticket demand. What about weakness? Can we understand weakness in the economy from trucks? Yes, they are saying that trucking markets remain soft. Now this matters because trucks usually weaken when inventory is sufficient, when end demand is slowing, and when pricing power is fading. Weak truck demand is another signal that goods demand isn't accelerating. So where is the support? There are some offsets, but they are narrow. They are saying that they see infrastructure spending, they are seeing power-related demand, but this could be because of AI. But these are policy-driven supports, not broad-based consumer or industrial strength. In macro terms, this is government-led stability, not private sector expansion. What about markets and reality from what they say? Well, the shares were up 4.5% on the day, but if you zoom out, you will see that the stock has been flat since 2021. Now, the flat performance of the stock is sending a macro message that the economy is stuck in low gear. Now, how you, as a forex trader or an equity index trader, how can you take railroad data and use it meaningfully in your trading? You can confirm or challenge macro narrative. You can validate industrial production trends. You can cross-check optimism in equities. You can understand inflation at the corporate level. So when railroads say that demand is subdued, it's a warning against chasing cyclical hype. The bottom line, my friends, no macro rescue in 2026, flat industrial production, modest GDP growth, sticky inflation, and cautious customers. Railroads don't spin stories, they report what's moving. And right now, they are telling us that the economy is slowing, not reaccelerating. So this is it. I hope you enjoyed how to read the economy using US railroads. Let us know if you have any other ideas about videos you would like to see. Thank you for watching. I'm Fotis here at TTT Markets. I'm going to see you in the next video.